Well, good afternoon, everyone. I appreciate the opportunity to see you all here today in our event, Navigating HOA Insurance Challenges in California. Definitely a topical issue in our state. My name's Dave Zapponi. I'm the CEO of ECHO, otherwise known as the Educational Council of Homeowners. I want to thank you all for participating in this community conversation today. Navigating HOA Insurance Challenges in California. ECHO is a statewide nonprofit association established to support HOA board members and engaged homeowners. Our mission is to foster a better quality of life in community associations through education, advocacy, and connections. For today's event, we have a few housekeeping items. You'll find these on the screen, presented on the screen. This slide deck has been sent to all registered attendees prior to today's webinar. Please take a moment to review our housekeeping items. Today, we have a large audience of HOA board members. We will do our best to answer your questions, but may run out of time. I believe we have more than 300 people registered for this event today. At the prerogative of the presenters, they may answer your questions during the presentation or during the Q&A session at the end of the webinar. We will answer as many questions as possible, but we may not get to your questions. So we're going to ask that you use the Q&A. In the Q&A feature, you use the thumbs up icon and vote for your favorite question. We'll use that to prioritize all the questions that come into us, and we'll be able to address those by the most popular question. Also, please keep your questions short and general in nature. We may pass over some questions if they're too long or too specific, because specific questions about your community are best asked of your attorney or an appropriate expert familiar with your situation. Now, the chat feature, you should use that to report technical issues. The questions go in the Q&A feature, the chat feature to report technical questions or issues, and to communicate directly with other participants in the webinar. We do not monitor the chat questions, the chat conversations for questions. Now, let me direct your attention to your monitor, where you will find our important disclaimer. None of what is said during this seminar shall be construed as specific legal or expert advice from the speaker, sponsors, or ECHO. If you wish specific advice, we encourage you to contact your attorney or another suitable expert. The information we provide during this webinar is educational in nature and should not be relied upon for specific decision-making purposes. Thank you. And today we'd like to ask that you welcome in our Q&A sponsor for today, Rebello's Towing out of San Jose. So Rebello's Towing is our #1 Q&A speaker. Our registration sponsor today is Levy, Erlinger and Company, LLP, CPAs. And I imagine everyone's working on their tax reporting documents currently, if you haven't finished them already. Now let's go ahead and move on to the introductions. Daniel Heaton Esquire is a senior associate at DeNiccolo Law APC and serves as corporate counsel for community associations throughout Southern California. He advises boards on the scope of their rights, duties, and ethical obligations under applicable statutes and governing documents. Corey Neubauer is the co-founder of Next Tier Insurance Services, Inc. He brings over 2 decades of experience in commercial real estate and HOA insurance. As an active member of ECHO and other associations across California, Corey is dedicated to educating and supporting board members and property management professionals in optimizing insurance coverage to protect their communities. So we'll turn this over now to Corey. Thank you so much. Take it away.
Perfect. David, well, thank you so much. I appreciate it. Thank you for everybody for joining us. I also want to thank Daniel as well. So We've actually done this presentation before with a smaller group with Echo. So we're looking forward to presenting this. So let's kind of jump right into this. Connor, if you can go to the first slide, that'd be great. So really, what we're looking at here is everyone is obviously aware of the recent LA fires, right? This has been a catastrophic event, and we tried to put some of the details together of what's transpired. So that first bullet point, which is the total loss, they're speculating somewhere over 250 billion in losses. So this is a dramatic event. And to give you any indication, when the Maui fires were about a year and a half ago, we thought that was very traumatic. And it turned out it was only somewhere in the neighborhood of about $4 billion in losses. So this is such a huge catastrophic loss that's going to have ripple ramifications. So Daniel, on your side, the legal aspects of this, can you kind of just touch on what we're going to see with some of this stuff? We can look at the other points, but maybe you can touch on some of that of what's going to transpire here over the next couple of years.
I think there's going to be a whole bunch that we're going to have to deal with, both within the associations and then just dealing with essentially government shutdown on this type of issues. You're going to have the city, you're going to have the building codes, you're going to have everything that you're trying to work through in terms of red tape, all slowing down because everybody's going that route. You're undoubtedly going to have a whole bunch of litigation filed against various entities up and down the coast for what happened. But in terms of the association, we'll get into a little bit later, how associations will need to respond, how homeowners within associations will need to respond, and what type of various documents will be governing what their options are. And then we'll kind of talk a little bit about, how we might be able to protect or better protect. I guess we can't really give you a full solution, but better protect and better prepare associations throughout the state that, haven't been hit, that hopefully will be able to put them in a better position to avoid all of the legal mess that's going to ensue up in the Palisade right now.
Yeah, perfect. Thank you. Yeah, and I saw one thing on the news report yesterday, which was kind of talked about the bottleneck. It was Karen Bass was saying, hey, come to our city event that has all 12 agencies that you can meet with at once to do your plans. So it's just a testament of there's 12 different agencies that these things are going to have to go through. So yeah, there's going to be those bottlenecks. We talk about permits. The one item, everybody take a look at these of the dramatic impact of these. And this is what we're going to talk about further is every HOA in California is going to be affected by this because of the insurance rates. So it didn't happen where you were, just like up in Northern California, the Paradise fires, right? That was in 2018. We saw a huge increase in rates over the past 5 years. The scary thing with this from a rebuilding perspective, right? 12,000 units that were destroyed and only 3,500 have been rebuilt 8 years later. So this is going to be kind of this is foreshadowing to what's going to happen in this LA area. We have the same conditions in Orange County, and we have the same conditions in San Diego. So none of us are immune from this. And if we don't make any type of changes, we're going to repeat this situation. So we'll go ahead and go to the next slide if we could.
Yeah, and just to build off what you had just said, we saw that Paradise impact in terms of race. You saw it again over the last couple of years with the Orange County fires and the ones around there. It's just going to exponentially increase.
Yeah, and speaking of that, we have a little video clip here. This is about State Farm. State Farm got a lot of heat for moving out of or canceling a lot of policies, specifically in that Pacific Palisades area last year. But they were trying to control the amount of losses that they had. So this just recently, State Farm has put a request into the Department of Insurance to raise their rates. So this is what the impact is going to be to all insureds. This talks a lot about personal lines, but your personal HO6 or your homeowner's policy is going to be affected, but the ability to get insurance for the overall HOA is going to be impacted as well. So, Connor, if you want to play that really quick, that would be great.
Of course, the wildfires in LA shed some new light on California's home insurance crisis. And today the industry is taking yet another hit. State Farm asking for an immediate emergency rate hike, potentially affecting all of its California policyholders. 7 on your side, Stephanie Sierra joining us live in studio to tell us more about the implications here, Steph.
That's right, Julian. State Farm says it was already struggling prior to the LA County wildfires. So tonight we're getting a closer look at just how bad they claim their financial situation is and what critics have to say about it. In the wake of the LA fires, State Farm sent this letter to the California Department of Insurance, warning of its, quote, dire financial situation, requesting approval for an emergency rate hike. An average 22% increase for homeowners, a 15% increase for condo owners, and a 38% spike for rental dwellings.
State Farm's having trouble remaining profitable in California. And a big reason is that the claims, the cost of doing business have gone up.
State Farm is the country's largest insurer, responsible for 20% of the premiums in the areas affected by the LA wildfires. The company says it's received more than 8,700 claims and has already paid $1 billion to customers.
When there are claims, it's more expensive to repair the homes or even have to rebuild a new home from scratch. Construction costs, construction materials, those prices have gone way up.
Perfect, thank you. So that just kind of gives you a little window into what we're going to be looking at. And if you notice that they said they've paid $1 billion so far. And if we're looking at $250 billion in losses, it's just the tip of the iceberg. So if these carriers are asking to raise their rates, because these are admitted carriers, the names that you recognize, the State Farm, the Farmers, the Allstates, those are admitted carriers that are regulated by the Department of Insurance, and they have to put in rate increase requests, much like the utility companies do. So they're saying, hey, we need to charge more so that we can stay in the state. You've seen, I'm sure a lot of the homeowners have experienced this directly, of being non-renewed by some of these carriers. The Department of Insurance isn't letting them raise their rates enough, so they're leaving the state, and that's what's happening. So we'll talk a little bit. You can go ahead and go to the next slide. We have another little video here to kind of just explain the overall California insurance market from a regulatory standpoint. So there's a couple little cheeky things in here, but I think it gives you a good little history lesson of where we started and why we're in this situation. And if we stay on this same exact course, we're only going to continue to experience skyrocketing rates. So Connor, if you could play that really quick, that'd be great.
Why did insurance companies pull out of California right before the wildfires? Well, in the 1980s, California passed a bunch of regulations on insurance companies. They included things like requiring the state to approve rate increases and prohibiting companies from passing certain costs on to customers. So after the 2018 wildfires, California went even further. They blocked insurance companies from canceling or not renewing policies for 1 year. Now, this might sound great in theory, but by 2023, 2 of the largest insurance companies, Farmers and State Farm, decided it just wasn't worth it to offer insurance at a rate that could lead to financial failure. So they would stop issuing new policies in California. To prevent this, Governor Gavin Newsom issued an executive order, which gave insurance companies a little more freedom, but it was too late. In 2024, they chose not to renew thousands of policies in the Palisades, Brentwood, and other areas at risk of wildfire. This forced homeowners into the state's expensive FAIR plan, which doesn't even have enough money to cover the losses. It means taxpayers could be on the hook. And because politicians haven't learned anything in the last 30-something years, they've issued another temporary ban on insurance companies declining to renew policies, which could cause even more businesses to leave the state for good. So how do we make sure that this doesn't happen again?
So again, a lot of good news in this sense. So yeah, to reiterate why they're leaving the state, right? Again, they can't charge enough money. And now a lot of these carriers have moved out, and you've gone to the California FAIR Plan. So I'm sure some of you are on the California FAIR Plan, or at least aware of it. Connor, if you can go to the next slide, we'll just talk about the FAIR Plan really quick. Okay, we might be a little out of sync, so that's okay. We can go to the next slide. That's fine. To the next slide, Connor. There you go. So what we were talking about before of the admitted and non-admitted carriers. So on the left are those admitted carriers, all the carriers that most people would recognize, especially for your own personal insurance. HOA insurance for your overall community gets pushed into this non-admitted market with a lot of different carriers. So all these carriers will write insurance, but they're not regulated by the Department of Insurance as much regulation, so they can charge a higher rate. And they have been, and they're going to continue to do that. So with all the regulation that's put in place, if you take the admitted carriers out of the market and there's no competition, it goes over to this other side, and they are charging pretty much these exorbitant amount of rates. Some of your HOAs, you probably experienced not being able to get full limit coverage. And we'll talk about some of the lending ramifications that happen with that. Or also there's super high deductibles. So there's a number of limitations that are happening, and we'll kind of go through that a little bit further. I think we can go to the next slide. So here's the FAIR Plan stuff. So speaking of the FAIR Plan, so the FAIR Plan is a government program that was set up as a last resort. It was established quite a while ago for crime insurance in parts of LA, but it's been expanded into covering property. So the FAIR Plan was supposed to, again, be a last resort. A few years ago, there was less than 5% of policies were with the FAIR Plan. Now it's something like 20% of homeowners policies are with the FAIR Plan. The problem with the FAIR Plan, it kind of works like Social Security. The carriers all pay into this fund to be able to pay out when there's a large loss. But we're looking at a multi-billion-dollar loss, and the FAIR Plan is extremely underfunded. I don't even think it's got 500 million in it. They just put an announcement out yesterday that they're going to be going back to the carriers asking for another $1 billion from the FAIR Plan. So again, this is a thing that it's a pooled program that everyone reports into or distributes into. And when there's not enough money, they go back out. So the question is, if these insurance companies are going to have to pay more money, where are they eventually going to get the money from? It's kind of like the federal government. When we say the federal government will pay for something, no, we're paying for it. So if the carriers have to shell out more money, eventually those rates are going to go to the individual. That's what happened in the campfires up in Northern California. The reinsurance was not enough and they paid out a lot. So now they're going to recoup by raising their rates. So we can go to the next slide. I think that's a little more about the FAIR Plan. But again, underfunding, it's extremely short right now, and it's going to continue to be tested. So, all right, we'll move on to the next. So, Daniel, let's talk a little bit about what if this happens. What if this happens to one of the HOAs? Hopefully, there's not too many HOAs that are on the line that have been directly impacted, and that's another whole conversation of what happens if you actually have a complete loss. But I think what the nucleus of this event is to really kind of educate everyone else if this does happen. So what can they expect, Daniel, let's just give them kind of a quick synopsis of if this happened to them directly.
Yeah, absolutely. There are a number of various types of impacts that you're going to be able to be seen. And like Corey said, this is, more so that you understand where the trends are going after this happens, so that hopefully we can get out ahead of it for your own community, so that you'll be able to at least lessen the impacts. But these impacts that you're seeing, one, obviously there's going to be that direct financial impact to these communities. You're going to have, in terms of the insurance side, escalating premiums. There's going to be potential coverage gaps. I'll give you an example of a specific community from the last fires where that occurred. Homeowners as a whole, I'm seeing in the Q&A discussions about percentage increases in premiums. We really need to be prepared that that's going to continue, that's not going to be something that just goes away, what we've seen before. As Corey mentioned earlier, even if you're not directly impacted by these fires, it's going to have a ripple effect that's going to hit your community in some circumstances. The other side of that is they're going to obviously have the coverage battles as we look at certain items within our CC&Rs, and I'll give you some examples in a second. The question really is your policy going to be sufficient in order to be able to cover the rebuilding cost in these type of situations? And you're going to find that, for the fires that we've been talking about, the insurance is just not going to cover it. There's going to be a gap that we're going to have to figure out how to fill. Connor, if you'll switch to the next slide. In most circumstances with HOAs, how we fill that gap and what we do when that payout from insurance doesn't cover everything is going to be governed by certain provisions in the CC&Rs. And really it comes down to that these communities that are impacted, the homeowners are going to have tough decisions that they're going to have to think about between, are we going to rebuild? Do we have sufficient funds? How much are we going to have to contribute in order to build up that gap? Or is this so significant? And I mean, think about the devastation in the Palisades where everything's just gone. Is it a situation where we just, it's time to get out, to cut bait and get out, to liquidate what assets we do have left, including the insurance payout, that you're able to get, and to split that, between the owners and then move on. Whether you're able to do that and how you do that and the process and logistics of doing that, we'll talk about in a second, is going to be governed by your governing documents. And so you're going to see that there will be CC&R disputes. And then in general, a whole lot of the ramifications that we talked about earlier, that there's going to be a lot of complex legal challenges involved that emerge when these communities face instances of total loss. And really, it's a time for you to be very closely linked with your legal counsel and with your insurance representatives, so that you can help navigate all of these different interests that'll arise. Go ahead, Connor, to the next situation. So those are just kind of the broad legal impacts, and then we'll kick it back over to Corey for various items as we start to talk about how to protect our communities.
Yeah, and I was just looking at the chat as well, and we're just going to kind of touch on, people are talking about some self-insure side of things, earthquake insurance. There's a number of what we call levers that different HOAs are activating in order to still maintain some type of insurance level. We're going to later on talk about FHA requirements, but let's touch on this really quick, and then I'll go through that as well. But taking action, your current HOA, in the past, you said, hey, if we did some landscaping, we did, these certain things, we've had, we met with the fire department, they took care of this, we have our fire sprinkler certificate. There's all these things that you can do to help defend your property. But if an event like the LA fires happens with 90-mile-an-hour winds, none of that's gonna hold up. But hopefully, this is not a common situation. But in other fire-prone areas, that this will help that. The challenge you have with insurance is before this was kind of like a good driver discount. If you did this stuff, you would get a better rate. Now the insurance companies are almost demanding that these things happen in order to remain insurable. And they're dropping coverage or saying, if you don't do these things, you're gonna be charged even more. So with these things, you need to be aware of these. We do see some HOAs that they kind of go out of order. They talk to the fire authority, they do all this stuff, and then they go back to the insurance company and said, hey, look at all this great stuff we did, we should get a lower rate. The insurance companies aren't necessarily taking direction from the local fire authority or other agencies to determine their risk level. They have their own actuaries and their own calculations to determine that risk. So for an HOA, before you go and do a bunch of this stuff, check in with the insurance company. If we do these things, will this impact our rates at all? So be a little more proactive with that, because it is changing overall, especially with just, the claims in these events are more often and they're larger in impact. So they're becoming, it's becoming catastrophic. We it seems like each one is more and more the next. Like it couldn't get any worse than this, right? We thought Maui was horrendous, and then we have a fire like this. We have the Camp Fire, the same thing. So we just don't want to see this again overall. And then speaking with self-insuring and some earthquake insurance. So right, earthquake insurance is an optional insurance, right? So you're not required. And Daniel, correct me if I'm wrong. Most CCNRs don't have a provision to require earthquake insurance, do they?
They don't. No. In fact, very few of them. You might have some that will address it and give the option and give kind of a little bit of guidelines there, but very few even talk about earthquake insurance.
Yeah. So, and then trying to find, exactly, we always like to see how do we compare to everybody else, right? Hey, what is everybody else doing? Well, I've seen anywhere from 10 to 18% of HOAs have an earthquake policy in some fashion. And there are different types of earthquake policies with higher deductibles and different limits. So it's, again, that's kind of a lever that you might move. For more coverage, you'd pay more. For less coverage, you'd pay less. So it's really each HOA board's risk tolerance to determine how they want to proceed, as well as obviously listening to the membership. And then someone touched on just being self-insured. So Daniel, what's your thought on just say, you know what, we're just going to save the money, and if something happens, we'll just pay for it, no problem. What's the legal downside of that?
There's a lot. Go to your CCNRs. I have not seen any CCNR set that allows self-insurance. There are specific articles within each of the CCNRs that require very specific policies to be in place, the type of policies, the extent of coverage. So if you're ignoring all of those portions of your CCNRs, you're clearly violating your documents. You're not upholding what you need to do in terms of fiduciary duties, and you're not only exposing the association to extensive potential risk if there's any type of an event because you don't have that coverage, but you're also exposing the association and the individual board members to potential breach of fiduciary claims for not fulfilling their duties under the CCNR. So yeah, don't do it.
Yeah, and I think that's important to explain, right? You're going to be sued personally, right? It's like, wait, I'm just a volunteer thing. It's just that's we see a lot of new board members where I don't know if they fully comprehend that, how impactful this could be if they don't make the proper decisions.
Yeah, and that'll be a situation where it becomes an easy analysis for the court to say, no, this is completely unreasonable and outside the scope of your authority. You should have done this. It was very clear, and you will be personally liable for that.
And I know you're an attorney and you speak on all those fancy words, but fiduciary duty, I think in layman's terms, right? What is help elaborate what that means. Yes.
That is the same. I mean, it's the highest duty you can assign in the law. It's the same duty that I have to any of my clients. And it basically means that when it comes down to a decision where I have to decide between putting your interests ahead of mine, that's what I have to do. And it's an obligation because you're entrusted with these people's livelihoods, their communities, their property, and their assets. And they're paying an enormous amount of money into the association on a month-to-month basis that you have control over. And so it's a requirement that you manage those funds in the way that the law requires. And there are heavy implications for people that don't take on those duties responsibly.
No, perfect. And yeah, because we see, we'll meet with a board and they're like, well, I don't like that option. I don't want to do that. And that's the mindset, right, of some, and we need to say, right, this is for the overall community, as well as the governing documents that control or guide us of how our decision making should take place. So, okay, perfect. I think we can bump to the next slide, Connor. Thank you. So I think we're this is you, Daniel. This is kind of a barrage of things, but I think this is a good place to land and kind of talk through some of the issues that these HOAs are going to be facing here, at post LA fires, I guess you would say.
Yeah, and this kind of goes into the same situation of what we were talking about before, but we're going to get into a couple of specific examples of these. But the concept is let's understand not only how on that first part, how the current wildfire that just happened is going to impact, but let's look at the full big picture. And not just now, but over the course of the last couple of decades, how things have significantly changed in both the legal landscape, but in particular the insurance landscape. And we talked about this a little in the last presentation that we had, Corey, that insurance and the ability to obtain. Whoops, I think we got somebody on. Needs to mute themselves if they could. The ability to obtain certain types of insurance has significantly changed between, say, 2 decades ago, when most of our governing documents were written, and how it is today. That it used to be very, very easy to be able to have policies that will not only pay out for the structural walls, but let's say you're in a condominium situation, it used to be very easy to get everything from the units as well. That's not the case now. It's almost impossible for boards to find that. So, and that's only going to get more difficult as we have situations like we just had with the Palisades, where that impact is going to continue to shape and reshape the insurance climate, how policies are written, how policies are obtained, and the legal obligations that boards and associations will have. You're seeing now that there's a lot of legislation going into effect, that has gone into effect, that is forthcoming, that will also impact the insurance climate. One thing that you might not think about, we've just gone through a long period of time. You might have heard the term the balcony bill, and maybe you've had to deal with that with your associations. Well, it's a situation where if you've got certain wood elements inside your community, in a certain size community, that you're required to do inspections to look inside the deck structures and to have that inspection and to repair it. Well, what most associations probably don't understand is that is now being utilized, compliance with those type of requirements, to be able to deny coverage. That if we're not doing what we need to do in terms of the balcony bill, that as we go to reissue our policies, or to seek a new policy, or for those of you that have been cut, to find something new, that'll start to be questions that will be asked. Is are you in compliance with the balcony bill? Or we had a little bit earlier, we were talking about various defensible space mechanisms. You see that a lot down where I'm at in the Orange County area, that there are great portions of land that are designated wildfire areas, or defensible maintenance or defensible space areas. That it used to be, here's our guidelines for how you can protect your associations. It's no longer guidelines; they're now required. And if you're not adhering to those, it's going to have a ripple effect on the insurance climate as well.
And Daniel, real quick on the being able to find that coverage, from your other point, yes, the CC&Rs of how they were originally written, right? When insurance was cheap, it made sense to, like you said, insure all the way into the very interior unit, all the fixtures, all the improvements, everything. But as insurance is becoming more and more expensive, those things have increased dramatically. And now HOAs are having challenges. Again, we're going to talk about the FHA stuff, but you're going to go a little further into some of the CC&R language, because a lot of HOAs are having to look at adjusting their CC&Rs, right, to accommodate this, because it's great if the HOA has the desire and the intention to get insurance, but if the market won't allow it or won't offer it, that's the situation that we're in now. Some of these communities in these higher risk areas, no matter how much money they pay, the carriers are not, they're not going to take on that risk. Or, it's, we've seen policies go from 50,000. If they want full coverage, it's $1 million. So do you bankrupt the HOA or do you find some other solution? So there's a lot of hard decisions that a lot of HOAs are being faced with right now. And I think the takeaway from this is other HOAs are going to experience this, especially with insurance rates continuing to increase. I like to say with our property management professionals and our boards, if your insurance line item went up 5x, would you be okay? Would it be an impact? Because that's what a lot of these HOAs are experiencing. They're going from a admitted carrier to a non-admitted carrier, and it's going from 100,000 to 500,000. It sounds absolutely insane, but that's where the market is in some of these higher risk areas. And with rates increasing and State Farm asking for more and this, we're going to continue to see a spike even more. Before this fire, we hoped that things would start to level out, but now we got another new paradigm shift. So anyhow, just wanted to touch on that. Please proceed.
On that last one that you said as well, I've got a lot of boards that are asking me, or that are, when they're trying to figure out how to prevent those premium spikes, the first thing that they've been going to are the loss sheets and seeing, how many claims have we been made, and how do we keep claims down so that it doesn't impact our premiums and cause that. And in all actuality, it has nothing to do with that. Well, I mean, that'll hit it, but it's not driven by that as much as a lot of our boards and associations think. There are many associations that have not made a claim in years, decades, that are still getting hit with those premium spikes because of what's happening in the climate itself.
Yeah, and that's as a result of insurance companies use a number of different models to determine the risk level, and one of those are fire scores. And CAL FIRE and a number of different organizations create fire scores for different, regional areas. And those fire scores have been getting higher and higher. So it's kind of like your credit score, right? Instead of it every time that fire score gets high, your HOA's credit score goes down. So it's going to cost more to get insurance. You didn't move, you didn't do anything wrong, you didn't file any claims, but the regional area has a higher risk level, so those rates are going to go up. So,
yeah.
Real quick too, a couple people were asking about D&O coverage. We kind of scared everybody with the you could be sued.
The personal liability.
Yeah, but from the D&O, Daniel, like the protection, if they're doing the right thing, they're going to be protected. The insurance policy is going to cover that. But can you kind of just touch on that real quick of how that plays out from a legal standpoint?
Yeah, and we'll go in when I get into the case study a little bit. There's going to be a difference between what we were describing before, as far as the self-insure, where that there are requirements and you're ignoring them. And there's going to be the difference between that and what the requirements are. And we've been talking about this. You just can't get the coverage that your CC&Rs require you to get. There's a big difference between I can't do it, I'm doing everything I can to ensure compliance without bankrupting the rest of my community. And I just can't do it, but I'm doing these steps and I'm going through this. There's a difference between that and just not doing anything. And it's the situations where you're not doing anything where that's where the personal liabilities come into play. D&O insurance covers, yeah, it's there to protect the board members who are doing what they're supposed to be doing. And it ties into portions of the civil code and the corporations code that, even if you are sued directly as a board member for breach of fiduciary claims, your coverage will kick in to defend you, not only in the litigation itself, they'll assign counsel and then pay for that counsel to defend you, but also indemnify you up to the policy limits. But there's also an extra step in there in the corporations code that if you're doing what you need to be doing, and you have that D&O insurance, even if the ultimate amount is higher than your policy limits, the corporations code will kick in and reduce that, so you're not hit personally. It comes into your D&O insurance. So that's why that's so key that your associations have that. It's why all CC&Rs will contain a provision that requires it. And we need to follow those provisions so that you're able to be protected.
Perfect. And I think you get a lot of business from this too, is the kind of infighting between board members and the stuff that the shenanigans that go on in between, that can have an impact, right? Because
Yeah.
someone sues a board member, this goes into your claims history, right? If the insurance company is going to pay out to defend you, so it is making those trying to keep, I don't want to say keep the peace, but Daniel, I'm sure you advise your clients, if things bubble up, address them quickly. Don't let things fester, because it just turns into a legal battle nightmare, right?
Yeah, absolutely. If there's an issue, investigate it, bring in your experts, make a decision, solve it, move on.
Yeah. And I think that's a, yeah,
don't
I think
ignore
that's
it.
yeah, that's a big thing, right? We're not attorneys. And whenever we have, give advice, we're like, this is the advice we give, but we suggest checking with your attorney. A couple hours billed by your attorney is well worth it. We see a lot of HOAs that will come to us and ask us for a legal opinion. It's really important to work with your legal counsel to understand that they can help respond, right? I mean, Daniel, I'm selling your service, but I'm just saying it makes sense to do that, especially now in this super high, climate. We're in the most litigious state in the union, and it seems to have the information and know where to go and wreak havoc, and that will have an impact on your insurance if you have a large claim. And those D&O claims, they take a long time, they cost a lot of money, and that's just like having a property loss on your loss runs or loss history. So it's important to manage. We also talk with property management companies and board members to manage those claims, right? Don't make nuisance claims. We talk about raising deductibles to avoid that. We see deductibles at 10,000, 20,000. Now we're seeing 25, 50, 100. Dan, you've heard this, but the definition of insurance is a transfer of risk. Let's transfer a little less risk to the HOA and put a little more risk on each of the individual unit owner. In the past, it's been the opposite, but because insurance is getting so expensive, especially when you're trying to do a larger community, it's best to shift a little bit of that to the individual unit owner and make that, and them getting that additional coverage will be a much smaller incremental cost than trying to get the whole HOA to insure everything. So these are the levers that are having to be moved now, and they're testing a lot of these CC&Rs. They're testing the market, and they're testing lending big time. So and then someone real quick too talked about the MODIS program. So MODIS is a companion policy that can go for earthquake. So it can be taken on its own as kind of a supplemental replacement, or can be a companion of the standard earthquake policy. We can answer questions at the end on that, but I just kind of wanted to touch on that. So Connor, if you could hit the next slide, that'd be great.
And you were just talking about, the potential change in CCRs and what they cover. And I think that goes right into this slide right here in terms of the various issues that will arise. And one of the big ones is that we're seeing that there's a big difference between, simply what you can get now and what you could back then. And as much as we'd like to follow the trends and be able to address and address things as they are right now, a lot of our CC&Rs or a lot of our governing documents are still in the past, or still in the history, because we simply haven't updated them. So these are kind of the different issues that will arise with these catastrophic situations, and where the problems come from. And one of the biggest problems that we're seeing is that we have associations that are tied to old governing documents that keep them in a situation where they're just it's impossible to comply with, or maybe you don't want to comply with, or I don't want to say don't want to comply. We want to have other provisions in place that we will comply with, because those are the ones that fit the scheme right now. But our boards and our management, and sometimes even our legal counsel, just haven't gone through the documents in specific detail for these type of situations to know how it's going to come forth, how it's going to apply, and do we need to change it and update it to fit our landscape right now. So that's one of the things that we would hopefully you'll take away right now, at least on the legal side, is go to your documents and sit down with your legal counsel and your insurance rep and say, are these realistic for what we have right now and for what we expect in the future? And if not, how do we change them and start working to change them?
And Daniel, what's that change of CCNRs look like? Sorry to cut you off, but I think this is, there's so many different, you're like, well, we can just change those ourselves, like just kind of high level. So, the boards understand, like, what does that look like? There's some voting.
Really important question. And I think it ties into the fact of why we need to do it now rather than later, is that CCNRs are meant to be static. That's why they have been static. And we have some that go back decades, because they're hard to change and they're supposed to be hard to change. But that process requires by law a membership vote, because each one of these homeowners and each one of these separate interests are bound by the CCNRs and tied to them and required to follow them. So in order to change them, they get a say and they get a vote. And often, many times with these CCNRs, the amendment provisions towards the end will require not just the majority vote of the members, but that's kind of a super majority, 66%, 75, I've seen 90, in order to approve a change of the CCNR. So they're very difficult to do. And so if you have a set of CCNRs and governing documents that are in the past and living in history and need to be updated, talk to your legal counsel and begin that process now, because it's going to require a full vote of the membership. It may require, if you're not able, I don't know if your community is kind of like mine, where people are all excited about getting out and doing the vote. Everybody participates, right? A lot of HOAs have trouble getting the ballots back, and in terms of the CCNR amendment, may by itself, regardless of whether the community is in support, if you can't even get 66% of the ballots returned, you're never going to pass that amendment. And so we really need to figure out exactly a plan for moving that forward and getting that done. And it's better to do it now rather than trying to address it after the catastrophe has occurred.
Oh, perfect. And then speaking of that, of kind of adjusting those CCNRs, we see there's a couple of questions about not having enough coverage. We've seen some HOAs that they've redone their CCNRs or rewritten their CCNRs to shift some of the responsibility to the homeowners, right? From a true, having an HO6 to an HO3 policy, which is like a structural policy. So how are HOAs doing that, and what are the limitations on that? I know if they're on top of each other, you can't do it. There's a couple things that not everybody can look to do that, but what if some of your clients what have you had success with in the sense of maybe shifting? It basically sounds like you're shifting some of the insurance liability away from the HOA and a little more back on the homeowner.
Yeah, and I think that might lead into the case study that we have and describing that. Connor, if you'll shift to the next slide really quick. I wanted to share this. This is language that I pulled out of one of my clients' CCNRs. Not to go into detail, I don't want to signal them out or anything. This is a client that is down in the South Orange County area, kind of the Trabuco Canyon area, right by where one of the big wildfires just occurred. This is their current provision for fire and casualty inside the article of the CCNRs that deals with insurance. So the insurance requirement, the one that they have to abide by, otherwise they might hit their breach of fiduciary duties, says that this is what they are required to get a policy to cover. And it says, in terms of fire and casualty, in an amount as near as possible, whatever that means, to the full replacement value of not just the common property, but also those portions of the units consisting of all fixtures, installations, additions, comprising a part of the buildings housing the units, and all built-in or set-in appliance cabinets and initial basic floor coverings. Basically, what they are required to ensure is everything except for updates from that the homeowners have installed. not just the association property, not just the common areas, but also the separate separate property units that are owned by the homeowners. Now, remember, back in the day, that was easy to get. We could do that. It wasn't an enormous amount. And so as part of that risk analysis that Corey mentioned, this community decided, let's do this all together. We'll shift this to the association, do it under one policy, make it easy. If the homeowners come in and put in, marble cabinets and, very expensive flooring or gold fixtures, then they'll be responsible for that. We'll just do, what was initially installed, and we'll cover that. Well, it was easy to do that back then. Nowadays, this association was right next to the Topeka Canyon Fire. There is no way that they're going to be able to find and fulfill this requirement. In fact, I went and talked to them, because they're having issues right now because they're uninsured or underinsured on this particular provision. And I talked to them and I said, well, what are you covered right now? And I looked at their policy currently right now, and this is the best that they've been able to get without completely breaking the bank, is a 25 million stop loss per occurrence limit, including wildfire, at 25 million. So the estimated full replacement value of this association, now I said that they're insured for 25 mil, is actually at 100 mil. A little bit higher than that, but around 100 mil. What does that mean? It means that they are $75 million off from what they are required under the CCNRs to insure. And they can't get any better.
So Daniel, with that, but so then that means if God forbid they were in a complete loss, they're going to get a check for 25 million to rebuild their community, and that's it, right?
Yeah, if that fire comes down and were to decimate that community like it occurred in the Palisades, they would have about 100 mil of potential replacement value, and they're going to get cut a check, hopefully, if they get it all, for 25 mil.
So then who's going to pay? Who's going to pay for the other 75?
Yeah, so if they are to rebuild, that would obviously go back to the homeowners to make up that difference of $75 million.
Right,
So
and I think that's the big important thing, right? The lack of insurance is going to be directly a result or impact on each individual unit owner. And I know you have some stuff about which, when we talked before, it was really interesting about when to dissolve an HOA. But I think this example that you brought up is a great example, right? Which I think you're going to go into that a little bit more. So.
Yeah, we'll hit on that. Before we leave this slide really quick, one impact that I wanted to point out specific for this community that I've seen and had to deal with. Now remember that they're not impacted by the fire. They didn't lose anything. They're not dealing with that. They just are underinsured if something were to happen in the future. But what they're seeing right now is they're having individuals that are trying to buy and sell their various separate interests, and homeowners are coming to the board and they're saying, I can't get this to go through. We can't get anybody to purchase our properties, because what they're finding is that when they start to enter into the escrow process and a lender comes in, the lender looks at the requirements for insurance. The lender then looks at the policy and says, holy cow, you guys are 25 on 100. You are so significantly underinsured, the lender's not going to touch it. They can't get any sign off. So none of these sales are going through right now, and homeowners are stuck with their properties because of this significant gap. So that's what we're dealing with right now, is trying to find ways, and Corey has probably a handful of different answers for this, of how you can potentially make up that difference and get that coverage that you need. But they're trying to find a way to be able to fund it and get them closer to that full replacement value, just so their homeowners can sell their properties.
Yeah, that's becoming a big issue. We got some more detail at the end on the FHA, because I think somewhere between right about 75%, 70-80% of mortgages that originated there through FHA, and FHA has those requirements.
So let's move over to the next slide, Connor, if we could. And this is it's difficult to see, so I'll just read for you the various different terms that are in here. But this is a provision, we've got a situation, we'll continue to go with our case study, our example of that association in Southern Orange County. What happens if that fire were to then come through and decimate that property? And as Corey mentioned before, they're only going to get cut a $25 million check at best. What then happens to that community when they're faced with potentially rebuilding not just one unit or one building or one part of the building, but the entire community that's decimated? That's what we're seeing in the Palisades. The entire area is just gone. So what do we do? There are provisions inside the CC&Rs that not many people know about. Boards don't know about them. Some management companies don't even know that they're there or what they mean. Many even association attorneys have never dealt with them. I've got a couple of board members that come to me and say, well, can we use this for various things like, leaks and floods and that type of damage? Not what it's used for, but there are provisions inside the CC&Rs, and they're usually labeled, this one's destruction of improvements or damage and destruction. And really what they're used for is situations like the Palisades, situations where there is some type of catastrophe that decimates the common areas, that it just destroys a significant portion of the association's common areas or the areas that are maintained by the association. And then it gives structures for how do we deal with that and what do we do moving forward. You can't read it, but in this one, 9.1 says, and it usually gives you a threshold percentage. If it's higher than this, we'll do this. If it's lower, we'll do this, dealing with how much of that money you get back from insurance. In this particular one, and this is the one that matches that insurance provision I showed you earlier, this one says in 9.1, if the insurance proceeds amount to at least 95%, then the board is required to levy a reconstruction assessment to provide the rest of the funds, which will be 5%. So what it means that if we get enough from insurance to reach that 95% mark, then the board has to ask the owners to make up the rest of it, the 5%. If it's less than 95%, then the board can levy a reconstruction assessment only if both happens. And it's the reconstruction assessment is approved by the owners, meaning they vote and say, yeah, we want to do this. Remember, make up whatever difference is less than 95%. And they're required to record a certificate that says, yeah, we decided we wanted to do that. But what happens if the owners decide we don't want to pay a special assessment to make up whatever the difference is? And remember, they're only getting 25 out of the 100 for this community. So it's going to be a significant amount that they will have to make up. What if we don't want to pay as a community that $75 million to rebuild our community? What then? Well, 9.2 says we're able to partition, meaning we're able to separate out the community that's tied together by these documents. If the homeowners decide that they're not going to pay for that reconstruction assessment, or if any types of the restoration or repair that is required by insurance hasn't started within 6 months, or if 67% of the association members decide we're not going to do this. So what we're seeing in these type of parts of the CC&Rs is really kind of an option of, this is the threshold where everybody has to repair, the association's obligated to repair, and if not, usually it's kicked to a membership vote. Go to example 2 really quick, Connor, on the next slide. It's a little bit different. This is not from the Orange County. This is from one of my other associations. It's actually up near the LA Altadena area in southern Pasadena. And this is their damage and destruction provision. It's a little bit different. 11.03 says, if the insurance proceeds, what you get back, plus whatever you can get with a regular special assessment that doesn't include a membership vote. Now remember, you're required under the law that boards can't specially assess for anything greater than 5% of their annual budget. So it's not very much. So insurance proceeds plus that less than 5%. If that together is at least 85% of the cost to restore, then they have to go forward and do the repairs and then assess the associations for the remainder. And then it says, unless within 60 days, 75% of the owners vote to say, no, we don't want to do it. And then 11.04 says, if the insurance proceeds plus that small special assessment is less than 85% of the cost to restore, and remember in our example, we're only getting 25 out of the 100, so it's going to fall in this section, then 75% of the owners have to determine whether they're going to repair it and specially assess the remaining. This one kind of flips it from what we said before, in the sense that under these provisions, at least 75% of the owners have to decide to move forward. And what happens if they don't decide to do that? Well, you go on to the rest of the provisions, and it talks about splitting up the insurance proceeds, selling all of the units individually and taking that fund of cash and splitting it up against against all the homeowners equally, with the exception of, if there's any type of mortgages that have been unpaid or any types of unpaid assessment, those come out and those get paid. And then what happens if the owners, 75% of the owners don't want to repair? They cut bail and they all walk away from the property, and then presumably it's sold to some developer that has cash flow that can step in and handle it. It's really interesting, and I would encourage you in this climate to go to your CC&Rs and see what it says in these provisions. And you'll see that there's going to be a threshold number percentage, and match that up against how you're insured and what the insurance requirements are, and kind of see how it would play out, and then see exactly how it deals with, what happens if we want to liquidate? What's the process for doing that? How do we do it? How do we then wrap up and dissolve the corporation itself and the CC&Rs? And it'll go into each of those areas. It kind of gives a roadmap for how to move forward out of these type of catastrophes.
Perfect, Dan. Daniel, I think we're running to the end. I don't know if you want to, Connor, if you want to switch us to the next slide. And Daniel, I think this is kind of what you were touching on.
Yeah, and I think this wraps up a lot of the conversation that we just had. When do we dissolve the association? Well, it's going to start with a huge widespread catastrophe that kicks it into those provisions we just talked about. Absent that, there's indications inside the CC&Rs you're not allowed to partition, you're not allowed to separate out things that are tied into the common areas. It holds it together until those provisions are kicked in. Flip it to the next slide, Connor, if you could. You're going to see that there's going to be situations where you have the infrastructure breakdown. You're not able to maintain the essential community systems. Think the Palisades right now, they don't have anything there. They don't have the utilities there. They don't have the various buildings and the structures in place anymore because everything's gone. You're going to have that breakdown, and you're going to have this institutional delay as everybody tries to bring it back into existence. It's not going to be something that happens overnight. So what do we do in the meantime? And one of the interesting situations there, we talked about mortgages, but also assessments. Just because your home is no longer there doesn't mean that you can now stop paying assessments or stop paying your mortgage. Those costs continue to run.
Perfect. So why don't we jump to the last slide, and then I'm not sure how we're going to open up for questions. Well, I do see a number of questions here, but I think the organizers have that.
If you have, Corey, if you have a couple of more slides left, you can go through them really quickly. We'll be good.
Okay, no problem. Yeah, this is the last slide. So really now we go to the FHA side of things. So we've been touching on this, and really this is the issue that you're running into with not being able to fully insure the property. You're not going to be able to lend on the property. So if you can't get a mortgage on a property, then how much is it actually worth? So that's the big challenge that HOAs are having. They're underinsured, and they're from a lending perspective, the lenders are not letting these loans go through. So what can HOAs do? There's a number of creative things that can be done, but each HOA is a little bit different. It just depends on how high the risk is. Checking with your current insurance provider for the master policy for options. We're always happy to help and take a look at anything. But at the end of the day, we wanted to just go through some of the challenges so that everyone kind of understands where this insurance market is, and keep up with Echo. They're putting out a lot of good stuff. There's a lot of very useful information out in the hemisphere or atmosphere. The news tries to scare everybody what's going on, but from an HOA perspective, this is only going to increase, and this spills over. Some people asked about their own personal insurance and trying to find coverage that's adequate. Again, it's going to go down to individuals that are having a hard time finding a carrier that will write it, and a carrier that will write it for the full replacement value. So it's going to continue to be challenging. We hope to do more of these, but we're available for answers, advice. Please don't hesitate to reach out. If you're working with a current broker and they're not communicating, it's challenging right now. Go back to them, talk to them, but also get other resources.
One of the things that we recommend, is we talk about these outdated policies and outdated CC&Rs that are just not matching the climate. And then you see these requirements with FHA lending, it says in there must be fully insured to 100% replacement costs. How do we solve that? And one of the potential ways that we've seen is to find a way to shift those responsibilities and reallocate those risks back to the homeowners. And it'll require one great thought as to what the available policies are, and bring in your insurance representative to help walk you through those potential options. But then you're also required to make sure that we're changing up what the obligations are in the CC&Rs to match what we're able to get. If the CC&Rs say the association has to have the policy, but we can't get it with the association, we can only get it with various homeowner policies stacked together, then maybe it's time that we look at potentially changing the CC&R requirements to match what we're able to get. And so really what we want to see is, let's start getting everybody down in the same place to talk about what our options are and work through these, and then match the legal requirements with the insurance possibilities, and move forward with your community that way.
Perfect. I think we can go to a few questions. Connor, I don't know if you were doing some polling questions or a couple. I mean, we try to touch on a few of them, but feel free to let us know what those are, and we can kind of address them.
Okay, let's go quickly to the Q&A.
Yeah, please.
To our sponsors, and then we'll go from there. Rubello's. So the Q&A session is brought to you by Rubello's Towing Service. Around since 1955. We want to say thank you to Rubello's for sponsoring this. Our two speakers are Corey Neubauer and Daniel Heaton. Thank you for presenting today. We're going to go ahead and take some questions in the Q&A feature. If you wouldn't mind taking a couple minutes here to put your favorite vote for your favorite questions. I'm sure you've been looking at some of the questions that have been going into the feature. I do know that Corey and Daniel have been responding to some of the concerns that were already voiced, so that's good news. So let's go ahead and do that. Make your votes right now. The thumbs up, if you wouldn't mind. I'd also like to ask our presenters to go to the Q&A feature in the upper right corner. You'll see it says most recent. Click the downward arrow and go to most up votes. And then you will have to update this every once in a while.
Got it.
Refresh it. Okay. And so I am doing that go ahead and start with 19 votes from Robert Holtz. Excellent. Would you elaborate on trend for HOAs to self-insure for earthquake insurance, especially recommendations? So do you have any recommendations?
Yeah, no, perfect. And we talked about, try to touch on that, the number of HOAs that have earthquake insurance. So that's a small fraction, 10 to 18%. What a lot of HOAs are experiencing now is their total insurance spend is getting much higher. So they're looking at where can they save some money. The earthquake insurance is, when it's affordable, it's a great policy to have. If you're going to get rid of something or limit it, it's a good place to start. So going with a higher deductible on that, most earthquake policies are set up by a percentage. So you might have a 20% deductible. So in Daniel's example or case study, it's 100 million. Nothing's going to kick in until $20 million of loss. A lot of people think, wow, that's not a lot of coverage, but it's made for a catastrophic event if you lost the whole HOA. So we see some HOAs that are moving that up to 30%. We did touch on the MODIS program, and the MODIS program helps to kind of supplement that. You can either get rid of the earthquake policy altogether and do a MODIS program. And what that does is it kind of gives each unit owner a policy against when those assessments come back to rebuild. So there's a number of different options that are on the table. But the MODIS program, especially if you just have a few homeowners or members that want earthquake, and maybe the whole ownership or the rest of the ownership is ready to get rid of it, this would be a viable option. But with earthquake insurance, if you have earthquake insurance, make sure membership is aware and fully communicated that this is going to be going away. Because as soon as that's put on, it's the expectation that we always have. So you need to document and explain why you took this insurance off if the board is making that decision without any votes. So hopefully that helps explain it.
I think we've hit a lot of them in the first part of it, but I did go down a little bit, and there's a discussion. I don't know if you see it, Corey, from Daniel Fort on the Zinsco issue. So has anyone
the lovely Zinsco panels?
Yep.
So Zinsco panels are also federal panels. What these are electrical panels inside the condos that have been recalled. So 70s, 80s time frame. These are known electrical fire starters, basically, and a lot of the carriers are excluding those. So before they used to carry or cover it, now they're not. So if you have those Zinsco panels, it's going to knock you out of a lot of these admitted markets and put you into a more higher risk scenario. The challenge with Zinsco panels is we have an HOA and it's got 200 units, and the HOA says, well, that panel is unit owner responsibility. We don't control it, right? So, hey, we can't do anything about it. Again, the insurance company isn't listening to standards or whatever. They want those replaced. So we see a lot of communities that have to make a big campaign to each unit owner has to go in and replace that panel in order for them to be more insurable. So if you have those panels, that's something that needs to be considered and looked at, especially if your rates are going up. We have one right now. It was by admitted carrier by farmers for many years, and they have Zinsco panels. They went from 70,000 to 700,000. And now they're actively trying to replace all of these panels so that they'll be more insurable. So that the result of not acting in the past was not a big deal. Maybe your rates went up a little bit. But now the result of not acting is substantial. Where I said that 5x increase, this is what's going to happen as you get knocked out of that admitted market into the non-admitted market. And now with the recent fires and all the losses that are coming, these carriers are going to be even more strict. They're going to want more information. We have a scenario where an HOA, the roof's only 30 years old, but it has a 40-year life. So they reserve for it. They're going to replace it in 40 years. The insurance company says, well, our standard is 30 years. We want it replaced. If you don't replace it, you're not up to our standard. We won't write you a policy. So those are things that the insurance company is now, or carriers are dictating what's going to be insured. So it's important to look at those things. But for those Zisco panels, that's a challenging one, and they need to be replaced. It's anywhere from $5,000 to $7,000 for each one, as well as facilitating all of those, getting the documentation, and being able to get to your carriers. But just one other touch on that would be the communicating with your carrier. If you're doing things to improve your property, make sure that your broker knows that and that they're communicating to the carrier, especially at renewal. Hey, we have plans for this. Even if you haven't done something, you've budgeted for it, you're going to start an improvement project that's going to make the building more secure, more safe, or bring it up. Let them know. We're trying to tell a story to the carrier to give them the best outlook on the property, so that you can get the best insurable rate.
So Corey, are you telling us that some of the Zinsco's panels are in private property and not common area?
Correct. They're for the individual. They're within the individual unit, like in a standard condo. It might have 2 or 3 stories.
Yeah.
So those are the individual electrical panels that service just the unit. And the carriers are requiring those. Yes, you'd have to replace the common area ones, but they want the entire property free of those Zinsco panels. So you would need to go into those individual units, and that's not what an HOA is responsible for. If the individual unit owner is responsible for their own unit, that's the challenge that you have. You turn into having to administer a renovation project inside of each unit. Mm-hmm. So it's super challenging. Yeah, it could take 6 months.
So here's the question of Dan: is can you mandate? Can the board mandate that the private property owners convert to GE panel or some other panel that's approved?
That's a Daniel question. What do you think about being able to mandate?
I think there are a number of different ways that you can frame it and handle it. And 2 come directly to mind that I was actually on a panel talking about this and trying to draft, to answer this last question. Is there a document that is available to HOAs that explains exactly what we need to do? The answer is going to be no, because each insurance company is going to be requiring different situation. But we tried to sit down and get something that will come as close to that document as possible. And these are the issues that came up that we're just talking about. And, we talked about, how can we go in and still handle it? And what authority would we be able to cite to that would allow us to step in and require owners to do something of their own property? And there are a couple of different ways to do it. One is this is a safety and security issue. You've got panels that are potentially exploding and causing, fire damage and potential damage, not just to that unit, but the surrounding units and the common area around it. So at that point, the association has an interest to step in. The other one is if you don't, then like as Corey said, your premiums are going to skyrocket if you are accepted at all. You might not even be accepted in terms of the policy that you're searching for, which has significant repercussions down the road. So there is potential authority for stepping in and mandating this and giving that authority to move forward. I think the bigger question is how do we do it from a reasonable stance? Do we want to step in and just say, you're going to handle it, get it done, or else? Or is this a situation where it might be better to say, hey, look, we've looked at all of these. We have each individual homeowner that has these panels. It's just going to be easier if we get one individual to come in. We'll negotiate, we'll handle it, we'll figure it out, we'll pay for it, and then have a special assessment that ultimately goes back to the owners anyway to handle that, just to make sure that it's all done and that there's no problems. That way it's not a huge burden, or not at least a large burden on each of the individual owners. And moreover, you're not going to be hit with a situation where you then have to go to legal counsel because the individual in unit 105 is the only one that has not changed out their Zinsco panel, and they refuse to do it, and you still don't have the coverage that you need, and you're still not able to go forward. So now we have to get into a giant lawsuit because you're forcing them to do it. Find a solution that will work for your association And it might be something that the board wants to take on itself, even though they're not required to under the CCNRs, to just make it easy on everybody and handle that.
Yeah, I think we see it. Money motivates, right? If it went up 10x, and it's like, look, we need to do this, or this is going to happen next year again. So unfortunately, it comes into when they're staring down a 10x increase and a $20,000 per unit special assessment. It's like, okay, maybe we should do something about it. That same thing with rewriting the CCNRs. If they're staring at that huge increase, then it motivates everybody. Because if we don't act, this is what you're going to be resulting in. So go ahead.
Well, I do know my carrier asked us to tell them whether they had Zinsco's or if we had General Electric or what type of panel we had. So we had to actually respond to the insurance. I think there was a question in the Q&A feature that asks, or maybe it was in chat, that asks, how do you tell, whether it's a Zinsco or not? Because there's some white label branding, if you will, there where a company bought the Zinsco's produced panels and put their label on it. So you might want to talk to your insurance carrier. Remember, if you do talk to them and it turns out to be Zinsco, they're going to tell you to make sure you get it replaced right away. You have to be prepared to replace it. So,
there are actually articles that go into that specific question as well. So if you want to Google it and figure it out, I think Echo has one that produces as well. That will go into those issues too.
There's actually plenty of stuff online to help people with those kind of those questions. And so anyhow, unfortunately, we're pushing, and we have 7 minutes here, so I'm going to have to do a close it out, and I will be staying around, and so will Connor. We can answer some questions, and you're welcome, Dan and Corey, to stay along after we do our closure here, because we do have to finish. And there are a lot of questions still in the Q&A feature, and some people put questions in the chat. So we'll see if we can touch those questions that are most important to you. But right now, I want to say thank you to Corey Neubauer from Next Tier. First of all, thank you so much for presenting today and being part of the team and getting the information out. That was it's very, very much appreciated. I also want to say thank you to Daniel Heaton, Esquire. He's actually the attorney for our association as well in Southern California. So we really appreciate your knowledge and expertise and everything you do for us and for Echo. And I am going to take just a few, maybe you can take a question here, because I have a tech glitch I have to get to here, and let you guys.
Sure. I see one near the top. We were talking about whether or not you have enough votes to approve the change in the CCNRs. And so if we don't get enough votes to approve the change, if there's that lack of return of ballots, do we go to court? And the answer is yeah. Hopefully you put yourself in a situation, and again, there are articles out there where you're able to utilize these provisions, but there's a provision inside the civil code that says that and it's written to address apathy, if we don't get enough ballots back to reach that 66%, that 75% percentage, then there's the option for the association to potentially petition the court to say, we've gone through this process, we've done everything we can to get the ballots back. Here's what we've done. We unfortunately didn't make it, but we did get over 50%, which is one key. You have to get at least 50% of the votes in favor. And then you go to the court and you say, Judge, reduce the requirement down from 75% to whatever we got, 62%. And the court will look at it and say, yeah, that's reasonable, and rubber stamp it, and you can approve it with your 62% and the judge's signature. And then it's considered approved as if it were just approved by the vote. But yeah, there's a provision inside the civil code that allows you to petition the court for that.
Okay, well, thank you so much for that, Dan. I appreciate you giving me a couple minutes to get the script up here.
Yep.
I want to say thank you to all the Echo members for participating today and supporting our ongoing Echo webinars. We appreciate it, and we've gotten to know many of you. And thank you for being part of this overall effort. For those of you who are not Echo, please consider becoming a member and supporting the HOA boards throughout the country. We simply You can join by simply going to www.echo-ca.org. That's our website, and clicking on the membership tab. You can become an individual member or a homeowner, an HOA community member. And if you become a community member, then everyone in your community has access to all of our materials. For ECHO members, thank you for supporting us, and please invite your friends, boards, and especially management firms and vendors to join ECHO. A simple invitation is often all it takes to encourage someone to join. If you would like to become more involved with ECHO, we have a few opportunities for you. Please refer to the slide. If you see anything that looks good, if you're interested in participating, join the ECHO Volunteers Club, and we have the Rosie the Riveter there. So I hope that some of you will join up. Anything from project-based to ongoing programming to just helping us with some of our events. We surely could use your help and your support. We are driven significantly by volunteers and by our primary members, who are the ECHO communities and the HOA individual homeowners. Now for a couple other announcements, or a few other announcements. The ECHO HOA University has an educational program focused on HOA board preparedness. The core curriculum of 10 courses is designed for high quality training and is available for HOA board members and interested homeowners and professionals and attorneys. Anyone who wants to take this are welcome to take it, but it's designed for HOA board members and people interested in becoming board members. Your participation in this program will earn you a certificate of HOA board member preparedness, BMP. And it's a pretty good course. We've had a lot of people sign up for it. 10 courses in the curriculum. And Dan's going to be teaching ethics just coming up here in a couple of weeks. So we look forward to seeing Dan and maybe many of you there. If you get your whole board to sign up, there's a 20% discount, I believe. The courses are offered. It's $10 a course, so it's not that bad anyway. So the courses are offered live, are online live, and most courses are recorded and or available on demand. If you or someone in your organization wants to enroll in the certification program, please contact Connor. He'll set you up. His email address is on the screen now. If you want to learn more about the insurance for HOAs, we will be having our annual, it's the 4th annual, Ask the Experts About Insurance on June 4th. And at that event, we will cover some of the basics in an objective and informational way, but we will break into special meeting rooms where smaller groups will meet with an individual insurance broker or agent, and they will be able to talk to you specifically from their perspective, and you can get bids from them or leads to contact them. If you have any interest, you can participate in that meeting, which is on June 4th. I believe Corey is going to be one of our presenters there, and you'll be able to have a in-depth conversation about your community with him at that event. We are almost finished with our Q1 resource panels. So we've had quite a few. I'm up in Northern California in this cold, rainy weather to do some of the Bay Area panels. Our last set will be the San Pablo Bay, which is in Benicia resource panel, the San Francisco resource panel, the South Bay resource panel in San Jose, and the Central Coast resource panel. Those panels are throughout the Bay Area and, of course, in Santa Cruz. So we'll be letting you know more about those as time goes by. San Pablo Bay Resource Panel is Tuesday, February 25th. Their title is going to be Building a Healthy and Productive Board. They're going to dive into some really important things about how to build a board and how to maintain a relationship with your community. Worth the drive. San Francisco Resource Panel is HOA maintenance and long-term planning, and an engineering firm, ABB, is going to discuss that and some of the new issues in San Francisco and with their new regulations or city ordinances. South Bay Resource Panel is Wednesday, February 26th. It's going to talk about plumbing. The number one issue for insurance is, and where they get the most claims, is with water damage. And so mostly pipes breaking and sinks leaking and that kind of thing. So this is a really good one. We have R&L Plumbing that's going to be speaking. They're throughout the Bay Area, good company, and they know a lot about plumbing. And then the Central Coast is going to talk about our new HOA elections. So they'll go through elections, but they're also going to talk a little bit more about electronics, the new electronic balloting that's now offered in the state of California. Legislation passed at the end of last year, and it's implemented this year. So if you're interested in that and learning about that, there is a little bit that you have to do to get ahead of the game on that. So we're good. We should be good there. We also have 3 larger in-person events planned for this year. And 20 or so exhibitors attending these particular events. In Northern California, in San Jose, in fact, at the Villages on June 7th, we have our 2025, we have our June 7th, 2025 educational seminar. That should be fun. I'm hoping to get a politician there like we did last year. We'll see what we can, if we can shake the trees and get somebody to come. So it's pretty difficult sometimes to get a politician to show. Last year we had Senator Cortese there, and he was excellent, did a great job. But we will be talking about other issues like insurance and other things there. In Southern California, we have an educational seminar on October 10th. Mark your calendars if you're in Southern California. We'd love to have you there. That's always a fun one. And then we have our legislative update in Northern California. It's a Northern California educational seminar. That's November 15th. That'll be simulcast as well for those of you in Southern California so that you don't miss out on the fun. There was always a lot of fun with this one and all of our in-person educational forums. And it's a lot of fun to give out the awards, and we do a lot of prizes. I think almost everybody walks away with something. Once again, thank you to Corey and to Daniel for this timely update on insurance, especially for those facing wildfire issues. And our heart goes out to those that were affected by the fires. They are devastating, and personally, they destroy homes and families. So it's a very sensitive issue. I know that because I'm in Santa Rosa, and the Coffee fire personally impacted members of my family. There certainly is a PTSD, post-traumatic stress syndrome, that does take effect here. So say hi to some of those people, give them your support, and help them get back on their feet. ECHO appreciates your investment in education to foster a better quality of life in HOA communities.